Hello everyone, my name is Hitesh and I welcome you all to TradeBrains YouTube channel. If you are new to our channel, please comment, like and subscribe on our videos, and please don't forget to press the bell notification icon. Now this video is very interesting because this video covers one of the most highest traded derivative contract in the world. I'm talking about the concept of forward market and futures market. Now we must be saying that forward contracts are not very high volume or not traded very much in the market, but they form a very important basis for understanding the concept of futures market. So let us jump right into our discussion of forwards and futures contract. Before understanding the detail of forwards contract, let us understand the history of futures trading in India. So the National Stock Exchange of India commenced trading in derivatives on June 12, 2000 with the launch of index futures. So index futures were the first product which were traded under the basket of derivatives in India. And then the exchange introduced the trading of index options. These are also based on Nifty 50 as underlying asset on June 4, 2001. And futures on individual securities were introduced in November 9, 2001. When I say individual securities, I'm talking about the shares of a company. Could be example like shares of HDFC Bank, ICICI Bank, Reliance Industries. All those shares were allowed to be traded under the purview of securities in futures market. And recently on Jan 11, 2021, NSE added Nifty Financial Services as another instrument that could be traded in the derivative segment. The Nifty Financial Services Index has been there with the Indian equity market for a long time, but recently only in the month of January they were allowed to be traded as a derivative product by keeping them as an underlying asset. So Nifty Financial Services has both futures and options contract attached to it. Now let us understand what exactly a forwards market. So forward market is an OTC agreement that sets the price of financial instrument for future delivery. It doesn't have a fixed marketplace. It's basically all the agreement is between the two parties involved in the agreement. So why was actually forward market introduced? So it was basically introduced to protect the interest of farmers. How does that work? Earlier, what used to happen is this: when the agriculture produce were produced, the farmers were not aware, and as in when the crops ripe up, what will be the price for that. So to protect the interest of farmers, when the agriculture produce were being sown or the seeds were sown, they were given an agreement to be able to sell the product at future price and the future date and in specified quantity. So they could actually lock in the price right now and not worry about uncertainties in future. And that is how it benefited the farmers. And under the forward contract, there is no third party involved. It is an OTC agreement. As I already mentioned, OTC agreement is a place where there is no third party involved. There is no exchange regulating. There is no regulatory bodies. It is an agreement between the two parties involved in the transaction. And upon the expiry of the contract, both the parties involved honor the agreement. It's basically based on mutual trust and respect. So let us understand the concept of forward market with the help of a simple example. Say Mr. A enters into agreement with Mr. B to buy 10 kilograms of silver 3 months down the line. And they fix the price of silver at current market price, which is at rupees 60,000 per kg, and the date of agreement is say 1st of January 2021. Now Mr. A is expected upon expiry to pay Mr. B a sum of rupees 6 lakhs, which is 60,000 per kg multiplied by 10 grams of silver. An important point of consideration here is that the future price of silver on the last day of agreement, that is on 30th March, has no bearing on the forward contract pre-decided price. Even though the price at the time of expiry might be going up or might be going down, but this forward contract will have to be settled at the price which was decided at the time of entering the contract. So that is the basic mechanics of forward market. Now what are the scenarios or what are the outcomes possible with this agreement? The first is if the price of silver goes up. It is possible that at the time of expiry of the contract, the price of silver goes up. Then in that case, the buyer of the silver makes a profit of rupees 10,000 per kg if the price goes up to say 70,000 rupees per kg for silver. And the benefit of buyer on the oral agreement will be 70,000 is the price at the time of expiry minus 60,000 is the price at which the contract was agreed multiplied by 10 kgs of silver, which is rupees 1 lakh profit for Mr. A as the buyer here. Now, what is the next outcome possible in this case? Say if the price of silver goes down. So here the price of silver goes down say to rupees 51,000 or by 9,000 rupees per kg. Then the benefit of seller here will be 60,000 minus 51,000, which is the price at the time of expiry multiplied by 10, which is a profit of rupees 90,000 for the seller. So that is how the seller benefits if at the time of expiry the price of silver goes down. And what is the third possible outcome? The price of silver does not change. It does neither goes up neither goes down. And then in that case, neither party either lose or gain anything in this contract. The contract is almost like null and void contract. Now, this is the basics of forward market. Now, TradeBrains Academy has launched a new course on the website of tradebrainsacademy.in. It is a free course available for anyone who is willing to come and learn and understand the concept of forwards and futures market. Through this video, I'm giving you a basics of forwards and futures market. But if you go to our website, you get an elaborate and complete understanding of the concept of forwards and the futures market. Now through this course available at tradebrainsacademy.in, we'll be understanding the concept of what is a forward contract, what is a futures contract, why trade using the futures, what is the margin required while trading a futures contract, and how is futures used as a hedging instrument. It is one of the most and highest used trading instrument in the market. And what are exactly index futures? What are different kinds of index futures which are available in the market right now? These are all the phases which will be covered on our website in the course of forwards and futures market. It is absolutely free course available for anyone who is willing to learn and understand the concept of futures market. Now, the best part about this course is this course is available both in video form and text form. So if the user is willing to learn using the video form, they can just understand and listen to the videos and see the videos. But if they're willing to learn by using the text format, even that is available there. Both the formats has been made available for the users. This is how the website of TradeBrains Academy looks like. These are a series of paid courses, and plus there's also a section for free courses, which is similar to the course of futures and forwards contract. Now, coming back to our discussion, how are forward contracts actually settled in the market? They either settle in two ways, either through physical delivery or through cash settlement. So how does physical delivery happens? In the case of physical delivery, as and when the contract expires, buyer of the agreement buys that much amount of silver, in our case here, from the seller, and seller in return gets that much amount of cash from the buyer as against exchanging of silver. And the other way of doing is to cash settlement. Now, this is the most common and this is the most prevalent method of settling the agreement. So here what happens is this: only the cash differential is paid. Supposedly, if I agreed to buy certain instrument or certain commodity at say 1 lakh 3 months down the line, and if the price of the commodity goes up to say 1,10,000, so I stand to benefit. In that case, the seller just has to pay me the differential of 10,000 rupees for the instrument or commodity. And in case the price of that product comes down to say 90,000 or 80,000, only the difference between the agreed upon price of 1 lakh and the current price at the time of expiry has to be paid by the buyer of the instrument to the seller of the instrument. That is how the cash settlement for forward contracts happen. Now, having understood what is forward contract, how the contract settled, we have to understand that it's an OTC agreement and it has its own set of challenges. Let's understand what are those challenges. The first among those is liquidity risk. Now, it is difficult sometimes to find a counterparty willing to take the opposite position to your view in the market, as there is no financial market or as there is no regulatory body to deal with these kind of products. So, which means the number of players in the market are lesser. And which is where the problem of liquidity happens for these kind of products. The second being default risk. Now, this is the most important thing. There is no formal agreement. There is an agreement between buyer and the seller, but there is no one guarding or understanding the mechanics, or there is no legality of the agreement, which is where the default risk is very high. Because one of the party might not agree to or might not choose to agree on the agreement at the time of expiry. The third being the absence of regulatory body. Now, these contracts are not regulated in the market. It's just an agreement between the two parties. It's an OTC agreement, which is where sometimes the compliance becomes an issue with these kind of contracts. The party might not be willing to honor the agreement, or there might be dispute between the prices agreed upon. Because of absence of regulatory authority, these kind of contracts become difficult to settle. Although you can go through a legal route, but we all understand what are the formalities and how long the procedure take there. Now, the fourth being, you can't bail out between the agreement duration. Now, it sometimes can happen that I have entered into a 4-month agreement with a seller. But say after a month or month and a half or a couple of months down the line, my view changes and I feel that the view of the seller is right and I am going to make losses in my agreement. Now, because of liquidity risk or because of the lack of liquidity, I am not able to change my position. Even though my views are wrong and I know about it, but I still might have to honor the agreement and just bear the losses till the time of the expiry. But if the liquidity was available, it would have been so easy for me to take a counter position, reduce my losses. Now, to solve these problems, the concept of futures market entered into the picture. Now, what are futures contract? Futures contract are also derivative contract, which have an underlying asset. To give you an example, if I am trading a Nifty 50 futures, which means the underlying asset here is Nifty 50 contract, and these are regulated by authorities and these have fixed expiries in the market. So to explain again in simple terms, futures are a derivative contract which derive the value from the underlying asset, which have fixed expiry and which are regulated by regulatory authorities. Now, how does futures contract solve the problem faced by forward contract? For example, the futures contract solves the problem of liquidity. Because it's regulated, because there's a formal place where this buying and selling of transaction happens, there's more trust in this contract, and whenever there's more trust, there are more players willing to trade these kind of contracts, and which is where the liquidity is available. You can take any number of quantity you want and you can express your view any way which possible. So which is where this contract solves the problem of liquidity. And the next problem which this contract solves is the problem of default. Now, what happens as these contracts are guarded by a regulatory authority? In case of India, it is guarded by SEBI, that is the Security and Exchange Board of India. So when you enter a contract, you have to keep certain amount of margin with the broker, and even the seller of the contract will have to keep a certain amount of margin with the broker, which is where the risk of default is covered to an extent. You can't default using the futures contract because you have already paid money to the exchange as a security, and in case you are willing to default, those security money will be used to pay off the other party. So the problem of default is solved by using the futures contract. The next is there's an official governing authority. As I told you, in India, the futures market are governed by Security and Exchange Board of India. So there's a formal authority which makes all the decision regarding the contract. And if, as and when any dispute arises, this official body takes up all the responsibilities and makes sure that the contract is settled in the right manner. And it gives the luxury of foreclosure. Now, I have already told in forward contract, as there's liquidity, so it becomes sometimes difficult to take an opposite position to your position in the market. But because of availability of liquidity, if you have say bought a certain futures contract in the market and your view changes before expiry, so you could take a counter position in the market by selling a different contract of the same underlying asset and hedge your risk and mitigate your risk. So this is how future contract solves these kind of problems which are faced by forward contracts. Now, what are the key features of a futures contract? The first being the prices are derived from the prices of underlying asset. So if I were to give you an example, say if I want to trade a Nifty futures, so in that case, the underlying asset held with Nifty 50 contract, and the movement of Nifty 50 contract decides the price of futures contract. So this is how the prices are derived from the underlying asset. The next being the futures contract are tradable. As they are liquid by nature, as they are regulated, as they are guarded by a regulatory authority, these contracts are very easily tradable in the market, and you can buy and sell any number of contracts you choose to at any given point of time. And these are well regulated. In India, these are regulated by Security and Exchange Board of India, and because it's well regulated, there is no risk of default, and parties are willing to take opposite or counter position in the market to your views. And it is cash settled. Now, the futures contract are generally cash settled in the market. Only the cash differential will have to be paid. Supposedly, if you have bought something in the futures market 100 rupees, and at the time of expiry, if the price goes up to say 110, or if the price comes down to say rupees 90, then you get profited if the price goes up, and you get losses if the price comes down. That is a simple mechanism of cash settle of the futures contract. And the fifth is the margin required. Now, this is one of the most important feature of a futures contract. How does that happen? As and when you enter into agreement, you could be either buying a futures contract or you could be selling a futures contract. You have to keep a certain amount of margin with the exchange. The margin will have to be kept with the exchange. Now, this margin is what guards the interest of the counterparty. Supposedly, if the party is trying to default, then this margin will be used to pay off the other party, and this is how exchange protects its interest in the market also. So that is the benefit of using the futures contract. And futures contract have specific expiry dates. Now, if I were to give the example again of the Nifty contract, now there are three expiry. There is the near month expiry, the middle month expiry, and the far month expiry. These contracts expire on the last Thursday of every month. And say if the last Thursday is a holiday, it expires the preceding day. So as and when the near month contract expires, another far month contract is added to the kitty. So at any given point of time, there are three expiry contracts running while trading a futures contract. Now let us understand the concept of futures contract with the help of an example of the Reliance Industries. Now the underlying asset here is the Reliance Industries cash market share. The spot price of one share is 1980. And the Reliance Industries futures contract is priced at 1971. Why there's a difference between the futures price and the spot price? I've explained in detail about these in our course, so please go and have a look there. And the number of shares per lot of Reliance Industries is 250. So supposedly if the share price goes up to say by rupees 20, then the futures price will go up to say 1991. Now we have to understand that the futures price and the spot price move at par. There is nothing called a beta factor here. They go at the same price and they come now at the same price. So the profit per lot in this case will be 1991, that is the price at the time of expiry, minus the 1971, which is the entry price, multiplied by 250 share, which is rupees 5,000 share profit while buying a futures contract. I hope this example gave you a clear understanding on the pricing and how do you trade of a futures contract. I hope this video was useful. I thank you for your patient hearing. I'll again see you in the futures video, and please do visit our website of portal.tradebinsin. It is a stock research portal. Please go there and understand the concept of the stock research there, and please also visit our website of tradebenzacademy.in, which is where all our free content and paid content is available for users. Go there and just enrich yourself with the learning of financial market. Thank you so much.